Interesting trends are afoot at the U.S. Federal Reserve again. I was scrolling through some H4.1 tables this morning, and isn't that what most normal people do on a Saturday morning? And I noticed a few things that raised my eyebrows. I don't want to cause everyone's eyes to glaze over by talking through a full table of numbers, so let me point out just a few interesting changes. I've circled them in Table 1. First, notice that currency in circulation has taken a small dip downward. So some physical cash has actually been retired. This is the first time that this has happened in a couple of years. Is it the start of a long-term trend? Possibly. We'll have to check back in a few months to see. What's more interesting than the trend in the reserve notes is the rapid accumulation of credits applied to the Treasury's general account at the New York Fed. The last time we saw such a rapid increase in this account was from March through July of 2020, when the Federal Reserve expanded its balance sheet from $4 trillion to $7 trillion in response to the anticipated economic effects of the global pandemic. Now, why are changes in this account important? To understand why, let's take a look at Figure 1, which is a plot of this account balance over time. We can clearly see the large buildup of this account balance from March through July of 2020 and its subsequent drawdown from January through October of 2021. Many people have wondered why the Federal Reserve was able to monetize $2 trillion of U.S. debt over the span of only a few months without creating an immediate tsunami of price inflation. And the buildup of this Treasury account credit is part of the reason why we didn't see the rampant price inflation, at least until recently. In addition to the obvious price dampening effects of slowing business activity, the Treasury account at the New York Fed mopped up over $1 trillion of newly created liquidity. As the Fed purchased Treasury bonds, instead of crediting the reserve banks with reserve assets, they credited the Treasury with money that could be spent at any time. One can think of this account like one thinks of the U.S. Strategic Oil Reserve. It's energy that's not available to the general public, but the government can mobilize it at any time that they see fit. So, although the monetization of debt in early 2020 greatly increased the M2 money supply, much of the money was not available to the general economy because it was sitting in a reserve account controlled by the Treasury. The most recent drawdown of this account from February through October of 2021 was spent on a giant economic stimulus package that saw checks sent directly to residents of the U.S. In theory, this mobilization of the U.S. Strategic Money Reserve, did I just coin a term, should result in price escalation of the items that we consumer buy. Is there evidence of this? There sure is. This is shown in Figure 2, which is a plot of the Consumer Price Index reported by the Bureau of Labor Statistics. We can see the definite increase in the pace of price increases starting in February of 2021, the point at which the Treasury started mobilizing the Strategic Money Reserve. Whereas CPI increased gradually at a pace of 1.7% per year over the past decade, the CPI increased by 7.5% over the past year, starting in February. Is it surprising that prices started increasing quickly when all of this money became available to the economy? It shouldn't be. What surprises most is that the price increases didn't start in early 2020 when the Fed monetized trillions of dollars worth of debt, and this strategic money reserve explains why. But now we have to ask ourselves about the effect of the large recent increase in the strategic money reserve. Cast your attention back to Table 1. Notice the last three lines. Reserve Bank credit, which is total Federal Reserve Bank deposits, has increased by 1.09%, but there was a large shift in where these liabilities are located. Reserve balance is contracted by $334 billion, or 8.36%. However, all other liabilities increased by $440 billion, or 9.35%. So reserves are being mopped up and placed in the Strategic Money Reserve to be mobilized another day. They are no longer available to the banks for lending. They are now available to the Treasury for spending into the general economy when the government sees fit to do so. What is different this time around is that the increase in the Strategic Money Reserve is not being accompanied by a large increase in monetized debt. In early 2020 to 2021, this reserve was used to control the rate at which the freshly created reserves from 2020 were introduced into the economy. Now the reserve is being used to take away the punch bowl. perhaps in an attempt to contain the now visible impact that credit creation has had on prices. We can see the impact that this is having on the stock market in Figure 3. The S&P 500 is already showing signs that it's anticipating tighter money going forward. Will we see the continued weakness in the months to come? Quite possibly. Much of it will depend upon whether the funds continue to flow into the strategic money reserve. My best guess is that this operation will continue until the cries from those who are experiencing stock market losses overwhelm the cries from those who are feeling the pinch of consumer price increases. The main goal of those in public office is to stay in public office, and as we know, there is a midterm election coming up in November. We'll have to wait and see what happens.